Helping Seniors Television, all about improving quality of life for seniors. If you're a senior, know a senior, or plan to be a senior, then this show is for you. It's all about helping you develop your own aging plan so you can age actively and with dignity. Helping Seniors Television from the Helping Seniors Network of information, education, and resources.
Today on Helping Seniors TV, join Beth Courtney of Financial Cornerstone Group as she presents her informational talk on 5 ideas you can use now on your financial checklist.
They had invited me to put together an article, and gosh, there are way more than 5 things, just so you know. So I had to narrow it down to 5 things that really should be on every financial checklist, and so we're going to go through those today. I gave you some folders just as support information for later if you're like, what did she say? Or how do I use that? You have those items in your folder, and you are welcome to call with any questions if you have any. So the 5 things begin with the B word. Not the B word you're thinking. I know what you're thinking. Stop it. It is budget. And you'll notice that I used another B word as well. It's called boss. A lot of people hear the word budget and they're like, oh no, not me. Nope, I'm not that person. I don't do budgets. I don't keep budgets. No fun, no fun, no fun. And believe it or not, I used to be you. That was me. I thought it was a pain and just trying to upkeep it. And you know how you procrastinate about things that you think aren't going to be fun? And I accidentally started teaching Dave Ramsey's financial piece like 15 years ago because the pastor of my church said, we have 50 people. I need you. You're going to lead a group. I'm like, I haven't even taken the class. But anyway, it was super helpful because it really gave me a different perspective. What I really understood was until then, my money was bossing me around. You have money left at the end of your month, or you have month left at the end of your money. If there's money left, what do you do with it? What happens to it? If you don't have a budget, it disappears. So the idea is to actually be the boss of your money. Let's see, I'm going to get used to the clicker thing here. Okay, so what you'll see in your folder, this is only half of it, but I'll just give you the concept behind it. It's called a zero-based budget. Does that sound familiar to anybody? Here's the idea of a zero-based budget. At the top, everything that comes in every month, the actual cash that comes into your bank, not your gross paycheck, but what physically makes it to your checking account after you have your withholdings and that kind of thing from your payroll or from your pensions. Then below that, you start putting the expenses. And what happens is, hopefully, the number from the top green line is bigger than the expense line. And if that's the case, you have something called a net discretionary amount. Net discretionary means what I took in minus what I put out, there's actually something left. And this is super simple, the whole concept behind it is instead of letting that money just disappear because you hadn't given it a name, give every dollar a name. So anything that's down here gets reassigned up here. So you can play with it, make copies of the budget template, but basically you're going to put some money maybe in savings, some money in vacation. There's a fun money spot. Everybody should have fun money because it's kind of like if you're on a diet and you never eat a brownie, you hate the diet, you're going off of it. If you do the budget, give yourself a little fun money, planned money that you don't get to argue about or anything. As long as it's legal, moral, and ethical, you get to use your $50 a month however you want and don't have to answer for it, and it makes you feel like you at least get a little fun out of the budgeting process. Any questions? This is interactive, by the way, so feel free. Okay. Actually, this is just a picture that you can get online. So lots of different organizations like Financial Peace University offer kind of suggestions for how much maybe you should be spending on your budget. You can just check online. There are several different opportunities there to kind of talk about that. Okay, number 2, build an emergency fund. Have you ever heard that concept before? So here's the thing about an emergency fund. Dave Ramsey likes to say that Murphy knocks on your door when you don't have an emergency fund. Oh, your water heater went out. Oh, your air conditioner went out. Oh, your roof needs repairing. Those things happen when people don't have money in the bank. So the idea is to build an emergency fund, and usually you want it to be equal to about 3 to 6 months worth of expenses. Not income, but expenses. The idea being, what if you didn't get to work or didn't have your income or whatever for a few months? It would give you time to handle emergencies if instead of just scrambling. So it's kind of like the idea behind that. And usually the recommendation, 3 to 6 months, you actually get to kind of decide for yourself. Now here's the big question. Since banks are paying so much money right now, oh wait, no, they're not. It's kind of frustrating because people feel like their money isn't working very hard for them, and it's true, especially with the current inflation rate. It is not really fun to be dealing with the inflation rate and making 0.06% on your money. So most of the local banks are still in that range, 0.06, 0.08. I mean, so negligible you don't even really notice that you actually got any interest. So one of the things that we've been recommending to people, if you're comfortable enough with putting money aside and just really not needing it within a 2 to 3 day warning period, what you can do is you can actually do what's called an online bank, a high yield savings account. So we actually recommend that you Google high yield savings account, and you can actually see that there are rates out there right now. It's so pathetic that I'm excited about this, I gotta say. 0.65%, woo! That is not a ton, but it's a lot more. If you have any sizable amount in your emergency fund, 0.65% makes a big difference at the end of a year versus 0.06%. So, and the way that they work is you go online and you register. It takes maybe 5 minutes. Don't think of it like the normal bank because it's not brick and mortar. You're not walking into this building and taking money out. You're not going to an ATM. It's actually your reserve tank. So only put money out there that you could wait 2 or 3 days to go back and retrieve. But some of the banks, some are Chase Bank, some names that you know really well, some names that you might not know, like Marcus by Goldman Sachs, Synchrony. It's pretty competitive right now. And the one fortunate thing about the unfortunate thing that's happening right now in our economy is that rates are rising. And so as a saver, that actually works in your favor. So you'll notice that the banks are really out there trying to compete for your business, so they're starting to offer larger rates of return. So it's worth a shot. Like I said, keep enough in the local bank that you can make it if you have an emergency, but then let the rest of it grow at a much better rate of return and then just move it back. One little tip, this may fall in line with something Tyler might have talked about last month, but when you open an account online, make sure that if they don't voluntarily ask you for your beneficiary, you voluntarily go look online to find, how do I add a beneficiary? One of the things that would happen otherwise is if you, let's say you've got $10,000 in your online savings account and you didn't name a beneficiary, and all your other affairs were completely in order, but that one thing didn't happen, and you moved to heaven, that could become a probate asset, an asset that has to be probated. So just always make sure you have beneficiaries listed on any accounts that you have. Any questions? All right. Okay. This one's fun. Build a diverse investment portfolio. Diversifying your investments. So when you, well, actually, I'm going to skip. I think the next slide tells you, yeah, okay. So when am I ready to invest? When does it make sense to invest? I really prefer that people first have their emergency fund in place because, again, you don't want to be in a situation where an emergency happens and you don't have enough cash to get through. It could happen at a time when the market is not behaving very nicely, kind of like all of 2022 so far, and you wouldn't want to be needing that emergency money and pulling it out of an investment that has actually fallen. So you want to really make sure that you have your nice, safe, risk-free money there for reserve, and then the investing is the money that you use after you've already preserved that. So a couple rules of thumb. How much should I invest? There's a range of suggestions, but typically 10 to 15% of your income is a really common number to be investing. Obviously, if you have excess beyond that, you may want to go further than that, but especially about 10 to 15%. And then here are the things that you need to think about. One of the things that you'll find in your folder later is a risk tolerance survey. So important. When you're going to invest, and whatever suggestions you get from everyone on the planet, your situation is your situation. Your risk tolerance is your risk tolerance. What you are comfortable with, risk versus reward, is your story, not what someone else says, oh, this is what worked for me. It's what works for you. So the risk tolerance, more risk equals more reward, less risk equals less reward. How much can you stomach if the markets are volatile? Then the time horizon is how long is that money going to be invested before you touch the money? Those two answers really help you understand where you should go with your risk tolerance and your time horizon. It could be that you might be risk averse, but if you know you're not touching that investment for 10 or 15 years and you need growth, you might go a little bit outside of your risk tolerance, or you might not. So it just depends. Oh gosh, what types of accounts? So have you heard the term, don't put all your eggs in one basket? Good old God's and Grandma's advice. Don't put all your eggs in one basket. So the idea is any of your money can be invested in any way of all the options that are out there. Certain rules might matter. So for instance, if you have money in what's called a tax-deferred investment, which might be like an individual retirement account or a 401k, there might be certain rules about when you can take it out according to Uncle Sam and follow those rules so you don't pay a penalty or you know you're going to pay taxes. But how you invest the money could be the same across a bunch of different types of accounts. So one of the things, we kind of like to look at your overall assets as a pie, and then you're going to assign different risk to different slices of the pie. So for instance, if you had a taxable account, that's going to be not an IRA, not a 401k. That's an account where you put money in and it grows, and the growth on that money is subject to capital gains tax. Lots of little rules there, but the bottom line is you'll never pay taxes again on the money that you put in, but you'll pay taxes on the gains. If you think you're going to use that money sooner, you're probably going to be more conservative. If you think you're going to use that money later, you're probably going to be more aggressive. IRAs, very often, that is something that you are planning for a very long time. Maybe same thing with a 401k, probably would be more aggressive. If you're more aggressive, you're going to have more of a concentration in things that are more like stocks. If you're less aggressive, you're going to have more concentration in more things like what are called bonds or alternatives. Stocks are the riskier in general. Bonds are the more conservative in general. Just to kind of give you an idea, you want to find what part of your overall portfolio should be protected and what can be a little bit more aggressive. And a lot of that's going to be based on how soon or how late you think you're going to touch the money. Make sense so far? Probably anything that's out in the market is really going to be subject to the volatility of the market. So if you ever see a chart that shows going back to the beginning of the market, it started down here, it does this, but it still is going up. It's called a mountain chart because it's still going up. But when this happens, it feels like this in your life. So you have to be prepared for it and diversify enough that you have a bucket that if you needed to get money, you take it from that more conservative bucket when the market is doing this to your more aggressive bucket. It's just having enough diversification. Any questions on that one? Okay. So number 4 is save taxes by learning effective tax strategies. How many know everything there is to know about taxes? Me neither, but we work with a bunch of CPAs. We work really, really closely with our client CPAs because kind of what I said earlier, each person's story is unique. Oh my gosh, you hear things all the time. Well, my brother-in-law said, or my sister's cousin's boyfriend's daughter said. I'm like, okay, but let's look at your situation and what impacts you. A lot of people don't really understand kind of how the tax system works. I would say most people don't. So it's been a little bit of fun for me over the years to be able to show people just a little bit of detail about how the tax system works. And actually, I'll show you a tax table in just a minute. Actually, I think I'll hop ahead for that just a minute. Okay, I'm going to do it. We're going to have some fun. When someone says, oh, you're in the 12% bracket, what does that mean to you? That you pay 12%. Now, the assumption is that I pay 12% on all of my dollars. But that, in fact, is not reality. We actually have a tiered tax system. So each different tier assigns a different tax rate. So in the end, you're actually paying a blended rate, a combination. So I'll give you just a couple things to look at there. It's in your folder. You can look at it whenever you want to. But the top left, if you're married filing jointly, what you see is that the first $20,000 is taxed at 10%. The next 63 is taxed at 12%. The next 95 is taxed at 22%, and so on. So you get the idea that what's happening is you actually pay a blended rate. So if your last dollars fall into the 22% bracket, you're not paying 22% on all your money. You're paying 22% on the last dollars. So your blended rate might be 18%. So it's really good to know that going in when you're making decisions about what I might cash out, how much might I take from my IRA or my 401k, how much of a capital gains experience might I have. It's good to become educated about these things so that you don't make mistakes that you wish later you would have known something about. So it's really just like even that one simple piece of paper in your folder can really help open your eyes to the process of how it works. A couple other hot dots on here. One is up there where you see standard deductions. So right now, we are under what's called the Tax Cuts and Jobs Act. It was implemented January 1st of 2018. It ends December 31st of 2025, so go get them. It actually put us in, I know it doesn't feel like this in real life, but it put us in the lowest tax environment we have been in decades. So we're actually paying less in taxes right now than we've paid prior to 2018 for decades. I would submit to you that when it sunsets, December 31st, 2025, that's probably the last time most of us in this room will see it this low again. That would be my guess. It was a few decades before we got here, and it could be a few decades before we get back here again. So it's really, I mean, it sounds terrible to say, but it's kind of a great time to be paying taxes. Because, again, lowest rates, what we believe, we already know that that is going to reset January 1st of 2026. We also believe that because Uncle Sam's been writing a lot of checks lately, if you haven't noticed, we do think that that's going to come to roost in later years. So we're really trying to help educate people on how that works. So just a really quick note, one common, actually, I'll go back there in a minute. I want to say one more thing. That standard deduction is higher. You probably noticed in 2018, all of a sudden it was like, oh my gosh, I get to write off all this money. I don't even get to itemize anymore because the standard deduction is so big. That's a good problem to have. If the standard deduction is higher than what you can itemize, that's a good problem to have. So when you're looking at that paper later and you want to see where you fall, you take your gross income minus your standard deduction to figure out where you fall on that chart. So it's kind of those top couple things there are super helpful in you figuring out where you land and how much room you might have to go if you want to make some decisions. All right, I think I'm going to go backward. Okay, great. All right, so understanding how the tax table, you don't have to be a genius and you don't have to be a CPA. Just that piece of paper alone kind of spells out kind of what it looks like. But I highly recommend that you work with a CPA if you're going to do anything taxable. As an example, one of the things that a lot of our clients are doing right now, they've accumulated a bunch of money in the tax me later bucket, which is your IRA, your 401k. Back in the day, all of us said it, oh, save taxes today, and then when you're retired, you'll pay less in retirement. And no, not necessarily, not if the tax rates are actually higher. It may not be the case. So we're trying to help people start shifting money from the tax me later bucket to the tax me now and tax me never again bucket, which means they're going from a traditional IRA to a Roth IRA. To get from point A to point B, you got to pay the taxes on the way, because Uncle Sam has been waiting for you to start spending that money that you've been building up in that bucket, and he wants his taxes. So if you're going to take it out of that bucket and move it to a Roth, which grows completely tax-free, he's going to tax you on the way. So it's just one of the many things you can do to really try to be tax efficient, meaning just make some really great decisions with the money you already have, especially while we're in this very rare window of time during the Tax Cuts and Jobs Act. So lots of complexities there, but just high level, there are opportunities if you work with maybe a CPA, a good accountant that can help you figure out, well, how much could I move and how much would it cost me? And now, once it's on the Roth side, when you put money in a Roth IRA, you're putting in already taxed money, so Uncle Sam can never touch that money again. And the lovely parting gift is that because you paid taxes today, Uncle Sam says, thank you so much. I am not going to charge you taxes on the gains. So if you have $10,000 over here and 10 years from now it's $20,000 and you go to pull money out, not a penny of taxes. With the IRA, grows, if you have $10,000 here and it grows to $20,000 and you go to take that money out, you will be taxed at whatever the then current income tax rate is. So it's very well worth just exploring your options, just to see if it's a fit for you to do some more tax efficient decision making. One of the things I mentioned was that it would be good to find great books. One book that I love, I get nothing from this, so this is not, and it's not a paid endorsement, it changed our practice. It's called The Power of Xero. And it talks about the fact that there are some steps, just like what I mentioned, there are some steps that you could take to be more tax efficient. And one of the reasons you might want to do it is because if you don't have too much money in this bucket, which is the bucket that Uncle Sam makes you draw from at age 72, whether you want to or not, he's going to make you take it out because he's been waiting. He's like, listen, I let you grow that money all along. You never paid a penny of taxes on the money when it was going in. So I'm going to tax you on what you put in. I'm going to tax you on the gains. I can't wait any longer. You're 72, start spending. They're going to make you do that. Well, if the less you have over here, the more you have over here, it's possible that you could actually work your way into the place where you aren't even paying taxes on Social Security. That is not the case for everyone. Certainly people with pensions, it's really tough to get there. But a careful planning with your professional, with your CPA, could really help you figure out how you might be able to get out of paying taxes on your Social Security or pay less taxes on your Social Security. And listen, I love our country. I feel super blessed to be here. Render unto Caesar that which is Caesar's. I am blessed to be a taxpayer and then live in a free country. But if there are rules out there that you could legally, morally, or ethically be more creative, the rules are made to do so, then why not learn about them and embrace them? Because you can use your money to be giving in other ways, other than the IRS, because we can't control what they do with it. Anyway, let's see. Okay, yep, I mentioned that. All right, let's see. We are getting through there. All right, take advantage of technology. Wow, we're already at number 5. Take advantage of technology. Have any of you guys ever used an app on your phone for anything? Just a little phone app. Okay. Have you ever used a budgeting app? All right. One of the things I put in there was a little article I found online with some different opportunities for actually using an app to manage your budget, your spending, your cash flow, whatever. So, for instance, Dave Ramsey, Financial Peace, he has something called the Every Dollar app. Now, you can go as far or as not far as you wish using technology. I completely understand the concerns that are there, just about security and safety. The one thing I would say is, if you bank online already on your banking, it's already out there, and if someone actually hacked your bank, they could actually transact something. But on the budget apps, it's a viewer. You're just seeing what's leaving your account, because you can hook up your checking account to it and your savings account to it and your credit card to it, but you're just seeing the transactions that happened, and you're getting yourselves more aligned and more on task. If you don't want to just do the paper one, if you'd rather do an app, you can actually use the app and keep yourself apprised of, oh, I was supposed to spend $300 on groceries, and I'm at $375, and it is week 3. I'm going to raid my cabinet. In my refrigerator. No more shopping, no more eating out. So it's just a way for you to be accountable to yourself, and maybe you realize after a few months, like, oh, I might need to change that category because I think I'm always going to go over. But this one, I can cut back on my phone or my cable or whatever it is. It's just a great tool to help you stay on top of your finances, and the fact that it automatically feeds in from your checking and savings means you're not doing all the manual work of saying, oh, what did I really do versus what I said I was going to do. So again, you can use the paper document. If you shoot me an email, I can email you the Excel version of the one that's in your folder. But also that list is in there of all the different apps. Mint is a real popular one that's been around for a long time, but there are several out there. I think, there are a lot of resources, and you have to pick through and pick what's safest and what works best for you. But I did try to give you a couple of tools there to kind of help you understand that. So let's see. That's what it looks like in your folder. Okay, so where do we go from here? So we just talked about 5 things. Like I mentioned up front, there are 1,005 or maybe 1,000,005 things that you could do. But this is just kind of kickstarting the process for you to just start thinking about taking control. That's really what it's about, is just taking control of your finances. It really was a light bulb moment for me when I realized, when I started to understand the concept of being the boss of my own money. Like, it hadn't occurred to me that my money was my boss. And it made a huge difference. And just telling it what to do is very empowering. So it's not as boring as you think. Okay, so one step at a time. If you've never done a budget in your life, you're kind of hating me right now. But just trust me. Just play with it. It doesn't have to be perfect. You just have to start. And you might fail a few times, a few months, maybe the first year. But just continue to go without giving up. Carve out time in a peaceful place. We're on such a rat race track all the time that we can always say, like, oh, I got to get to that. Oh, I got a budget. Oh, I really need to get a hold of my finances. But we're just so busy. You have to make a date with yourself. Be very, very intentional. Carve out time for you or you and your spouse to actually go through these things. And it's so enlightening. I really can't encourage you enough. Be honest about where you are and don't beat yourself up. Yesterday is history. Doesn't matter what happened before. Today is a new day, and today is when you start getting a hold of it. It's completely fruitless and not at all productive to spend time beating yourself up. New day, new plan. I mentioned about the available tools and resources. I mentioned about the emergency fund. One great way to get a handle on your budget is to get rid of debt as much as possible. The dollars that you were paying on debt could now start going into the Bank of You instead of Bank of America or wherever you've been paying bills. Seek expert advice. Evaluate your progress. Inspect what you expect. Again, you might make adjustments, but inspect what you expect. And again, begin today. Don't dwell on the past. Thank you very much for your time and attention. Appreciate it.
I'm Joe Steckler. Thank you for joining our program today. I'd like to remind you that our senior information line is available to you at 321-473-7770. There you can get help and direction that could be helpful for your specific situation or circumstances. The work of helping seniors is very important, but we can't do it alone. That is why our sponsors here in Brevard County are so important. I'd like to thank our many area sponsors, businesses, and medical providers who support the mission of helping seniors that help us carry the cost of our media efforts. If you'd like to join us either as a business partner or simply donate as an individual, we would welcome your call at 321-473-7770. You are always welcome to visit our website at www.helpingseniorsofbrevard.org. Thanks so much for your help. It does make a difference.